Good day, traders. Richard Jacobs here, and welcome to what I hope will be the new format for our weekly perspectives report. For those of you who have been subscribers to our perspectives report, you know that I usually send out on a Sunday afternoon or evening. I usually send out a weekly email, just setting out our perspectives, our views on where the market is and what we think will happen during the course of the next week. And so I thought for this week and perhaps as we go forward, depending on the reception that the report enjoys, I thought I'd do a video and just run you through not only what our views are, but the process that we go through in looking at the market from a technical perspective and establishing what those views are, because I really believe that the learning that comes from watching this video or these kinds of videos is not really related to the actual output, what I think the market is going to be doing in the next day or week or month or whatever the case may be, but rather the learning comes from understanding what kind of process, what are the things we're thinking about as we go through the analysis, because that allows anybody watching the video to actually learn from that and start applying those same principles or extract from what we're doing certain techniques for looking at the market. So let's jump into it for this week, and what you can see up on the screen is it's a series of charts of the top 40, and there's a couple of things I wanted to cover for this week. The first thing I want to pull up here and just pull up it, maximize it, is what you'll see up on the screen is a daily chart of the top 40, but it's a 3-line break chart. Now for those of you who've been following some of our material, you know that one of the things I really enjoy looking at is 3-line break charts. Taking applying the lens of a 3-line break chart to price structure and drawing some inferences from that. And so if we look at this daily 3-line break chart, a couple of things that one can see happening here. Firstly, what I want to pick up on is if we go back, and we're going back to May last year. So we're picking up quite a bit of data in this analysis. You'll see that the market pushed down, did a rally, and then put in this lower low, then rallied up again, put in a lower high, and then pushed down to make this lower low. So we had this clear downtrend leading all the way to the end of December last year. And then notice what happened. The market started to retrace again, and we watched it, and in line with expectation, what we would have expected is for this downtrend to continue, because that's all the information we had at that point in time. But instead the market pushed up, and very interestingly, right here we break structure to the upside and we put in this higher high now, or new structure high, if you want to be perfectly precise. Now what's interesting about that is then the market put in a retracement, and then around about the 13th of Feb we had this continuation move. So at this point, when analyzing the market, what we're looking at, we're saying, look, the market was in this downtrend, then we had this break to the upside to form this new structure high, and now it's retracing, and we may be starting to move into a continuation phase in an uptrend. But instead the market pushed up, and then it simply fell over and pushed down again. Now what this effectively is a false continuation move that we're experiencing there. And generally when you find these, especially on a daily 3-line break chart, you'll see it followed by quite an emphatic move to the downside. There's another example right there in 22nd of June. The market was in this uptrend here, it wasn't an uptrend, it pushed up, it retraced, it broke structure to the upside, pulled back, and we looked for the continuation move right there, but instead the market rolled over and pushed down. Now this was the result of Brexit. just for completeness. But as you can see, as soon as you have that false continuation move on the 3-line break chart, it's followed by quite an extensive push to the downside. So what does that mean? Just, without going into the more detailed price charts, well, a couple of things. We could say, look, this market's pushed down, and we've seen the emphatic move to the downside following the false break over here, and now we need to start, positioning ourselves for the real continuation move, because notice what's happened here. We've got this move up. The market's effectively just retraced all the way down here, and we've got that little false continuation. So let's with that in mind, let's just switch over to the actual price chart. I'll show it to you in a bit more, gives you a more detailed view. So this is the price chart, exactly the same thing we looked at, but this is now the price candle daily chart. And here you can see the move up, the break of structure to the upside from the end of December all the way to the top here. And you can see the market started making a nice A, B, C, D, higher high, higher close, nice trend developing over here. The market then retraced back down here, and this is where we had that false continuation, because what we expected to happen is we expected the market to pull back and then continue to the upside. Instead, it started to push up, but didn't manage to hold those levels, and instead started pushing down. Now what we're seeing is it's making it made that lower high over there, pushed down, got quite messy over here in mid-February. As anybody who was trading through February would have realized, the market pushed up, put in this lower high, and then pushed down again, broke structure to the downside again. Now, are we in a downtrend or are we in an uptrend? What does this all mean? Well, again, it depends on the lens that you're looking through. On a short-term basis, one could certainly look at this and say, okay, the market pushed down, pulled back up into, retraced a bit, and then pushed down again. We have this continuation move to the downside. So what do we expect to happen? Well, we expect the downside move to continue if we're looking at that shorter term time frame. But if you're looking at this bigger, the bigger picture over here, we could say, look, we had this move from C to D, this call it this impulse leg that was printed over here, and all we're seeing here, this entire section here, everything that's happened from the high that was hit in mid January of this year has simply been a retracement. It's a retracement, or a complex retracement to be sure, but certainly a retracement within this bullish impulse leg here. And what you'll notice is that we've had this retracement all the way back into, I've put it in there, but this is a 61.8 percentage retracement of this CD leg. So we're in that zone now. Also, and this is I've highlighted on the chart, we've got this falling wedge structure right here, and again, to be sure, we've had a deep retracement within this wedge structure. But if you look at it, we've had this push up, or put in this first leg to the top, then a second leg down, market tried to push up again, failed to break through, and now the market's effectively fallen down here. On Friday we had fairly bullish day, although it was bullish on the day, but within the context of the of last week's overall performance, still a relatively bearish week as the market pushed down. So one of two things can happen over here, or one of three things can happen. The market could just continue to move sideways here, to be honest. But if we have this bullish momentum continuing at the start of the week, we could see a push towards the top of this falling wedge structure. That's something the bulls will be pushing for. It's one of our favorite views as well, and obviously then the bulls will be looking for a break of that structure, and when we get to that, if we get to that, then that's something we'll also analyze and evaluate on a daily basis. The bears on the other hand are looking for the market is simply continue to the downside to push right through the bottom of this wedge structure, and in fact they'll be eyeballing this C level here, because a break of this CD leg, which is really contained, I mean everything's been contained within that leg from the end of December. A break of that C level, which comes in around about 42,800, would be extremely bearish. So really it's going to be a battle to see which way the market moves, a battle between the bulls and the bears. Now, given that we're coming in around about 44,300 here, we've got about 500 points to the upside to the top of this wedge that we've got to play with on that side, and we've got quite a substantial piece of space to get to the downside of here. So it's not something that's going to play out within the next week, I don't think, but it is something that we're definitely going to keep our eye on as the week begins. Now, the other thing I wanted to highlight here before I get into the analysis of what other markets are doing is we don't use many indicators on our charts generally. I prefer to look at price structure and price structure through the lens of three-line break charts. But if I just eyeball what's happening with the stochastic here, it's quite interesting to see that we do have some positive divergence developing as the market's putting in this is pushing lower over here, while the stochastic is making a higher low. So that's something to bear in mind, and may also add to the case for moves towards the upper end of this, or the ceiling of this falling wedge pattern over here. Bear that in mind. And then the other thing, it's something I've highlighted to our daily subscribers as well. What we have up here is a normalized average through range chart, and what I wanted to point out here, because it's something that we did a lot of work, we've been doing a lot of work on lately, is that and we're seeing it materialize in our intraday trading. The market volatility in this market has essentially completely dried up at the moment. If you look at this normalized ATR, you'll see that we're coming in at the moment around about 10.7. We peaked at on the 24th of February about 12, and ever since the that initial surge, that initial start to January, when we had nice flowing trends and volatility, it's simply dried up and then fallen down over here. Now, this makes it exceptionally difficult to trade or on some of the longer time frames within an intraday context. And the reason is, what you're finding is, of late the market's putting in ranges of 300, sometimes, well, I think it was one day in last week we put in a sub 300 range, but 300 to call it 600 points in a day between the highest point and the lowest point. Now, if you want to trade intraday, and let's say you're trading off the 15-minute charts as we prefer to do, what that means is, if you take on just 150, 200 points of risk, which, you know, within a 15-minute context, if you're looking for nice trend runs, isn't that much. You would need to capture the entire day's range just to get something like a 2-to-1 reward to risk out of the trade. And that's what's making trading, and has been making trading, exceptionally difficult over the past, well, I say over the past maybe 8 weeks, 7-8 weeks, since we post that initial surge in January. But if you look back, those of you who've been trading or traded through last year will remember that period post. I mean, we had Brexit happening over here, but post Brexit, we just had that, volatility just dying again and pretty much running sideways. We did sort of rally up a bit towards the end of September, October, and but until the results of the US election, again, you had a fairly low level of volatility, and that also made trading quite difficult over that period. Compare that, to example, to early 2016, where we had great volatility in the market, great trends developing. You could run trades for multiple days, in quite and they used to progress quite steadily. So what we're finding at the moment is, with this lack of volatility, that it makes trading, or trend trading specifically, quite a difficult proposition. Now there's a couple of things you can do to counter that. One is you can simply not trade, just stand aside. If you're running trend trading systems on an intraday basis, for example, just say, look, as long as the ATR is under a particular level, I'm not going to be trading this market. I'm going to wait for volatility to return to the market, and volatility will return to the market eventually. The other thing is, you can change time frames. You can drop down a time frame. 500 points on a 5-minute chart is substantially different to 500 points of range on a 15-minute chart, if you're looking at it within the context of the entire day. Of course, that in itself brings other complications into the trading equation. You need to be more hands-on in terms of the trades. You need to be able to react faster. Spreads don't necessarily, or you're going to lose more money to spreads, because if you're putting in 5-10 points of slippage per trade, that hurts you more if you're trading on a 5-minute chart versus a 15-minute chart versus an hourly chart. So those are all the things that you need to bear in mind. But what I want to highlight to you today, by just looking at this, the normalized ATR, is that we are in a low volatility environment, and that is part of the reason why trading has been that difficult of late. Right, so we've looked at the 3-line break charts. We've looked at this falling wedge structure over here, with options to the upside, which is, as I said, is our favorite view at the moment. But there is the potential for a push to the downside, and if we break that C level within the next few weeks, that would be extremely positive for the bearish traders out there. The other lens that I like to pull up is, I like to look at 3 markets and just do around the world, not even around the world. It's just 3 major markets that I like to. Sorry, it's 4 major markets that I like to eyeball. So let me pull those up, and we can have a look at what's happening right there. The first one is the dollar rand exchange rate, and again, I'm looking at it through the lens of 3-line break charts. And on the left hand side I've got the weekly 3-line break chart, on the right hand side I've got the daily, and you can clearly see the the weakening trend on the weekly. You had this weakening trend as the rand really blew out into January of last year, nearly hitting 17 rand to the dollar. Then we had this retracement all the way back down into the into the 1340s, 1350s. Then the market put in a continuation, and we all expected it to continue to the upside. But then we had this sudden strengthening, which really kicked in for the most part, as you can see from the chart, from around about mid-January this year. We had the strengthening as the market pushed down. So effectively, on a weekly basis, what we've got is we've got a strengthening trend, because the market's broken structure to the downside versus the dollar. And so we've got this strengthening trend that's happening within the USD rand charts. Now, if we look at that in a daily context, you can actually, you can clearly see the strengthening trend over here. The market's making lower lows, lower highs for the most part, and that's really just continuing. Every time we start to see the market rallying, everybody thinks this is the point at which the rand's going to blow out for whatever reasons, political reasons, etc., etc. But then we get this continuation move to the downside. So, and the important that's an important thing, because as long as the market is making these lower lows and lower highs, we have to respect what the market's telling us, or what the charts are telling us, which is that the rand remains within a strengthening trend versus the US dollar. So be very careful about picking a bottom here, or at least if you want to flip the chart around the top in terms of the strength of the rand, until we reach a point where we're breaking structure to the upside. One cannot discount further strengthening of the rand. So what are the levels that we continue to eyeball? Well, a very significant level, and you can see it clearly on this weekly chart, is if we were to have a weekly break and close above that level, the 1450 level, you can see it clearly there. It's a nice round number as well. That would be highly indicative of further rand weakness happening. But I mean, at the moment we're sitting at, what are we sitting at? 1320. Sorry, we're sitting at 1320. So we've got quite a bit of headroom before we reach that point, and we're in a clear downtrend over here. So and if you look at the most recent action over here, I mean, we pushed down to the downside with a low of, or a daily close around about 1287, and to be sure we're now pushing up, and the rand is weakening, but at the moment it's just a retracement, as each of these levels were, just a retracement within a downtrend. So be careful about drawing too much, or by calling and saying that we're reaching a point where the rand's simply just going to blow out, and that's going to bolster our stock market because of the impact of the rand on our rand hedge stocks. Right, so that's the rand. The other market which we obviously have to look at, is the US, and this is the weekly and daily 3-line break charts of the S&P 500, and trend should be pretty clear to everybody looking at this chart. I mean, this thing is just pushing up, pushing up, pushing up, pushing up on the weekly, pushing up the daily. I mean, there's no two ways about it. When you start doing your intraday analysis, you can drop time frames. Let's, for example, look at a 1-hour chart of S&P, and there you can see it becomes quite interesting, because what's happened on the 1-hour chart, I mean, there's the major trend coming up, then the market start pulling back, we have the continuation move, then it broke structure to the downside actually on the daily chart, and on the hourly chart, and we actually started putting in lower lows and lower highs. So we were actually in a downtrend on the hourly chart. But what I want to point out is, if you look at the most recent leg, we actually had a break of structure to the upside again, which happened probably on Friday around about, what was it, 4 or 5 a.m. So Friday morning we had this break to the upside again as the market continued in the direction of this major weekly and in fact daily trend. And if you just want to apply some structure to the 1-hour chart of the S&P, have a look at this. We've got this pool, actually looks very similar to our daily chart on the top 40. You've got this falling wedge structure, and what's happened is we've broken out of that. Now, where to from here? Well, a couple of options. I mean, we've got a break of structure to the upside on the hourly. The market's now putting in a retracement. We expect the continuation of this move to happen over here. Where would it happen? Well, we could see a move back to, I mean, it could test the breakout, well, it is at the breakout level, but it could pull back to the top of this of this wedge pattern and then continue to the upside. So that is something to consider. Or it could just, you know, start to push up from this level. But at the moment, what we're seeing is that even on the hourly basis, the US markets are in a continuation phase to the upside. So, you know, if you look at it within that context, just, you know, the US is supporting our perspective that we're going to see further upside. Of course, the rand isn't. I'm just going to jump back to that rand chart so we can draw a final conclusion there. You can see, as I said, you know, we've got this strengthening trend in the rand, and all we're seeing is a retracement. But consider that the retracement, so the weakening of the rand, the retracement is aligning itself with the continuation move in the S&P. So what we're seeing, and this is a very short-term perspective, we're seeing a weaker rand as the currency retraces, and we're seeing a stronger S&P as well as continuation move to the upside. When those two factors align, one can reasonably expect that we're going to see some upside developing. So looking at the start of the week, it does appear that we're going to see the market continue to the upside at this point. But let's look at the last two markets that we do analysis on. One is oil. Oil has just been in a, you know, if you follow our analysis here, what we had is we had this massive downtrend in oil, and then we had this retracement, pushed down, put in this higher low over here, but then broke structure to the upside in around about October, and then started forming this this uptrend on the weekly basis, and now it's in a retracement within this uptrend. So oil on a weekly basis still looks bullish. If I look at the daily chart on this side, again, you know, we've got this this move to the upside all the way into the beginning of 2017. Then the market pretty much stalled, and we had a massive sideways move. You'll see there that we had this last three-line break candle printing around about the end of the first week of 2017, and then we had this retracement candle printing on the 10th of Jan, and then the next candle actually prints on the 8th of March. So between the 10th of Jan and the 8th of March, we pretty much ran sideways in this market. That actually becomes clearer if you look at, I'm just going to switch from a three-line break chart into the actual price chart. Let's just clean that up. Let's have a quick max at that. So I mean, look at this. We had this this move up into December, and the market put in continuation move to the upside, and then things just pretty much stalled there, and we had this range bound market all the way across here. We've now just broken out of this range to the downside, and that's what we're looking at as the retracement of this leg over here. So the oil market, in so much as there's been a lot of weakness over the past few days, is and we've had that downside breakout of this consolidation pattern over here. Do bear in mind that contextually we're still in an uptrend, and this is simply a retracement within the uptrend. Where the market finds support, that's not something that one can readily predict. I mean, we've pulled back into previous price structure over here, and it's still looking fairly bearish at the moment. But if you were to do some analysis, maybe using something like a Fibonacci level, you'll see we're just tapping the 61.8 of this low high move over there. So maybe the market can start finding support around about that $50 a barrel level over there. Just something to eyeball within the context of our analysis, as I said. the market remains in an uptrend, although retracing in an uptrend. Right, let's just get my 3-line break charts back again. And there we go. And then we'll just, last thing I want to look at today is gold. And again, gold's quite interesting. Had this big push down into 2016. This is the weekly 3-line break chart. Then we have that massive rally. If anybody who was trading through early 2016 would remember all the short squeezing happening as the market broke structure to the upside over here. Then it started retracing again. Whoopsie. What have I done here? Let's just fix that. I've broken it. I'm jumping to $50,000. There we go. Sorry about that. So as I said, we then have this retracement over here, this continuation move from January. Didn't go very far before the market actually started retracing again. So on a weekly basis, not looking that great, although again it's still in an uptrend. It's now put in a lower high. If you look at the daily, you can actually see it quite clearly over here. The market pushed up all the way into those levels over there, and then started this this pullback that broke structure to the downside on the daily, and then started putting in a series of lower lows and lower highs. Where are we now? Well, interestingly enough, if you look at the most recent price action, what we've had is a push up, a continuation to the downside, and then a break of structure to the upside. And in that context, everything we've seen from 6th, 7th, 8th, 9th March has been a retracement within this leg up over here. So in order to maintain this, call it bullish, or this little uptrend that it's currently looking to create over here, market's got to hold this level right there, so around 1188, call it 1190. If the market can hold this level and start continuing to the upside, that would be quite bullish for gold. So that's a key level to keep an eye on. And of course, if we use gold as our proxy for whether or not our proxy for equity risk, the bulls will want to see the market push down and break the structure to the downside, whereas the equity bears wouldn't mind some upside in the gold to start materializing. So that's what we're looking at from the gold perspective. So putting all of that together, as I started off saying, our expectation remains that we've got some bullish momentum behind us in the short term. So as we head into the new week, what we're going to expect to see is the market start to push up and continue to the upside, and we'd be eyeballing the top of this this falling wedge over here for a potential move in the market. Guys, that's pretty much it from my side, and I hope you guys found this useful. As I said, this is just kind of thinking, or the kind of analysis that we do on a weekly basis as we prepare for the new trading week, and we plan how we're gonna structure our trades, whether or not we're gonna trade, bearing in mind the commentary we made in terms of the market ranges and the current volatility levels in the market, etc. And also, where we expect the market to go, with the idea that one tries to align any shorter term trading opportunities with that expectation. But that's it for this week's Perspectives Report. I'm gonna send it out to you guys in a few minutes. Hope you enjoy it. If you've got any comments, please feel free to drop me a line, and I'll try and improve on it. I know it's a bit long, but this is the first time we're trying to do it this way, and I have no doubt that as we continue to do this, we'll refine it a bit more. Until we speak again, guys, have a good trading week, and hope it is a profitable one for you. Cheers.